Garima Kapoor joining in, the Executive Vice President and Economist at Elara Securities, Vivek Johri, ex-chairman at CBIC with us, Uday Pimprikar, National Leader in Direct Tax Services at EY with us this morning. Welcome to all of you and thank you so much for speaking with us on India Market Open. Uday, I'm going to come to you first, just to understand the magnitude of the change from industry perspective.
So, yeah, I mean, a lot of now discussion is going to go about how that transition happens and so on and so forth. But look at the massive kind of effort put out by the government. The average rate before this change was anyway actually much lower, at around 11.5%, 12%. Okay, I think that with all of these changes happening, the average rate is going to come around 10-ish. Clearly comparable with most of these tiger economies and Southeast Asian economies for GST. I think I wouldn't have ever thought that, especially when GST got implemented, that the rates would be as benign and as muted as we are kind of looking at. A lot of changes have happened on the rate front from 18 to 5. But not only on the rate changes, there are several other measures that the government is taking, very, very cognizant about making it easier for people to do businesses, allowing businesses to get more certainty. There have been amendments that have been kind of proposed for exports, refunds. There was a big controversy that was suggested earlier in relation to exports done by especially captive centers, and that has been entirely resolved by making it very, very clear.
So let me one sec. Sorry. So let me understand that. I think what you're saying here, Uday, and let me see if I've got it right, is that there are a lot of incentives, and I know they're not necessarily linked, but the context is important. There are a lot of incentives which help those sectors and companies which would have been hit by tariffs?
Yeah, I mean, both front. One is the government is seeking to make far more certain the lives of exporters by allowing refunds to be granted based on risk much, much faster than otherwise. The second bit, especially on services, or in addition to this, on services, the government has removed or made amendments or proposed amendments whereby controversy related to especially exports being done by services sector is removed. There was a category called intermediaries which was creating some bit of confusion. And that provision has entirely been removed. Now, most services, exports, refunds will be granted with much more certainty. So a whole host of factors for Indian businesses to give certainty seems to have been brought to the table.
Okay, important points that you're making. Uday, I'm just trying to understand also, Garima, I'll come to you, from the perspective of the impact on the fisc. The cost is being pegged at less than 50,000 crore rupees, and while there might be some debate from the states, the unanimity that was on display yesterday, passing all of these measures in a day, speaks to the kind of consensus that has been built by the administration. What about the tailwinds, though? And we've spoken so much about consumption, the sectors that get that fillip. When do you see that come through? Do you anticipate right from the end of September that will start playing out?
The consumption benefit in some sectors should start playing out around Diwali. But remember, in certain sectors where the Q1 was very dismal, where we had very sluggish summer, particularly consumer durables sector, there is significant inventory in the channel as yet. So the impact in these sectors probably will get delayed to a little longish period. Also, the second aspect, to add to what my other panelists were speaking in terms of benefits kicking in for sectors which saw significant tariff impact, I would like to specifically highlight textile sector, where inverted duty structures have been corrected, which has been a long-standing demand of the sector. There's a fiber neutrality that has got kicked in. So the working capital issues and the compliance burden that the textile sector was facing is likely to ease. This to some extent will also help to mitigate the tariff impact that this sector, particularly the labor-intensive, MSME-intensive sector, was facing. Now, coming to your question in terms of consumption, a lot of things are falling in place for consumption. Beyond GST cuts, there has been tax rebate that kicked in FY26 budget. There are tax rates that have got executed, especially by MPC RBI. There is significant visibility of low and steady inflation. There is an impending pay commission that will kick in sometime next year, first by center and then by states. And then you have these GST cuts. So I think the levers for consumption have fallen in place. Perhaps all and most levers for consumption have fallen in place. I've never seen so many triggers for consumption simultaneously fall in place probably for last decade. So I think the context is very, very much supportive or consumption uptick, if not immediately because of the inventory in the channel in some sectors, then clearly from second half of the current financial year and from the subsequent financial year, I think your portfolio should be very favorably placed towards consumption stocks.
Yeah, no, completely. What's the GDP boost that you have penciled in after you've seen the announcements yesterday, Garima?
I'm penciling in about 100 to 120 basis point GDP benefit that plays out over 4 to 6 quarters.
Wow.
That almost completely nullifies the negative impact that we would have seen because of the tariff on exports to US, which we penciled in at about 75 to 80 basis point, including second round impact.
That's huge. 120 basis points on the upside in 4 to 6 quarters is big, big. Vivek Johari with us, ex-chairman of CBIC. Mr. Johari, very good morning. You know, what I wanted to understand from you is the implementation pace. And it's all very exciting. This is going to happen from September 22nd. That's something that we told you first. But in terms of actual implementation, the people who have to do it in the departments, in the state governments, how does that work?
I don't think that is an issue at all, because, from the point of view of government, all that needs to be done is to notify the new rates. The only challenge perhaps would be in implementing the procedural and reform processes that have been, the processes that have been reformed. But because, our entire GST system is digitalized, and those processes have to be changed on the GST and, IT backbone. That may take a little bit of time. But I think the government is quite clear that at least the center will implement some of those changes starting November. And that should also fall into place. Apart from that, like somebody was pointing out in your panel, I think the government has done a very good job of putting out all the information that is possibly needed for implementation, whether it is for industry or for our officers, very, very clearly, both on social media and otherwise. That also will help the implementation process. The third thing is the industry was a little anxious about how much time they would have, before these changes kick in, because they have to revamp their ERP systems and they have to, tweak them to accommodate the new rate structure. But I think they've been given sufficient time. There is, of course, attention about, the festive season approaching and the movement of stocks and all of that. But I think there's sufficient time given to industry to plan well, which is also a very good move. I do want to say, if you allow me, about this is like a reform windfall. And why I say that is because when I look at the rate structure now, I'm unable to find, very few. In fact, I'm unable to find any anomalies in the rate structure which could possibly lead to disputes or contentions in future. So the point I want to make is that the rate structure that the government has now put in place with the blessing of the GST Council is going to be a stable one. And we were talking about boosting consumption. I think that's a very good signal for investors too. And if you recall, one of the objectives the government has been pursuing for a long time is to shore up private investment. So I think apart from the immediate impact it will have on consumption, I think the second order effect will also be very positive on private investment, because the rate structure is extremely stable. And I doubt that you would need to tweak, the classification of products under different rates.
So an absolute
yeah.
boost, Vivek, in terms of consumption. But one sector that we need to look at is insurance. And like insurance, a lot of other sectors that could be impacted in a similar fashion, because full exemption with regards to GST on insurance companies, that would mean that they would have to bear the GST when it comes to input services, right? So how do you look at that aspect? Because now it is seen as a negative impact.
That's true, but considering that there are other insurance products that would still be taxable. By other insurance products, I mean other than personal health insurance and life insurance taken by individuals. There are corporate insurance policies, and there are other insurance products which these companies are selling, on which the applicable rate will continue to apply. So yes, there will be some impact in terms of non-availability of ITC on this segment of their operations, but the rest of it will be a smooth flow. I think the overall objective is what needs to be appreciated, which is the low coverage and penetration of insurance in the country. And I think that is the objective which the government is trying to fulfill. And the insurance companies have already assured the government that they will pass on the benefit in terms of lower premiums.
Okay. Okay, let me take this moment to thank all three of you, Garima, as well as Mr. Johri and Mr. Pimprekar. Thank you so much for taking the time and speaking to us this morning.